with us. Steve Brice joining it on the show to try and figure out which way the Fed is going to move. Steve, we can, we're going on debating whether 75 bips is something that the Fed will act upon, considering 100 bips is not off the table. Which side are you leaning on, 75 bips hike or 100?
So we're in the 75 basis point camp. We're not sure that really at this stage accelerating from an already very, very rapid pace is the right thing to do. Obviously, you did get that inflation print last week, which was certainly a surprise to markets, and that's made people a little bit on edge. But I think from our perspective, 75 basis points is probably more than enough from the Fed this time. I think what will matter thereafter is obviously the messaging that comes out with regards to the pace of future rate hikes, the level of the terminal rate, and obviously we do get updated economic and interest rate dot plots, forecasts and projections in this meeting, and they extend another year, of course, as well. So we're going to get a lot of information to digest from this meeting, and that's what everybody's going to be doing, obviously, when we get the result.
Anita, that's the other thing that I wanted to talk about, because there is anticipation that there is going to be a fresh dot plot, and that's going to include the outlook for up until 2025. Needless to say that there are more such hikes coming, considering this one is going to be the third of such a quantum.
Yeah, no, I mean, it certainly looks that way, right? So another, whether it's another 75 basis points or they start dialing back the pace of rate hikes in meetings to come to sort of 50 basis points initially. But we certainly see that interest rates are headed higher. I think the key thing here is, do we get any indication that they're worried about growth? I mean, we are certainly worried about growth, right? So, we've had a very, very severe tightening of financial conditions. One view is to say they're not tight from a historical perspective, but compared to where they were a year ago, obviously financial conditions have tightened massively. That is going to be a headwind for the economy. We're already starting to see some signs of weakness coming through in terms of some of the corporate announcements. So trade flow companies suggesting, FedEx saying that the environment's weakening. So there are some signs of weakness coming through. At the moment, the Fed's very, very focused on the labour market strength. But labour market to us is a lagging indicator. So by the time that weakens, it's going to be way too late. So still heightened risk of a recession over the course of the next 12 months. But any indication from the Fed that they're worried about that would be a big positive, I think, for markets.
And that largely seems to be, the consensus that this time around it's not about what the Fed does, but what it says it could do in the future. And do you think that's going to be awfully critical?
I think it's going to be very, very important, of course. And although we'd like to see them sort of softening their tone, I'm not sure. I think this is probably at least a meeting, if not two meetings, too early for them to do so. So I think they're going to be very focused on saying that inflation is still incredibly high. And yes, we've seen inflation expectations are under control, but they're not below 2% or anything like that. So they're still higher, maybe not necessarily higher than they would want, but certainly they're not indicating that inflation is going to fall dramatically in the coming 12 months. So from that perspective, they're just going to be very focused on inflation for now, I think. And that's going to be the message we take away from markets. And from an equity market perspective, you could argue that a lot of this is already priced, right? So maybe we do get a relief rally if they don't sort of double down on another 75 basis point hike at the next meeting. But I think there's still quite a lot of bad macro news to go through over the next 6 to 12 months, which makes us a little bit cautious about the longer term outlook.